Hello and welcome to the Quarter 1 2023 review. This time I'm going to do things a little bit different, and I'm going to start off with what I want you to take away from this. Then we'll kind of get into the numbers a little bit. So there's three things that I really want you to take away. The first one is that uncertainty in the markets is unavoidable. And really, that is why we get any type of return. Think over the last 5 years. Let's think over the last 3 years, everything that's happened. We've had everything from a global pandemic. We've had inflation concerns. We've had Russia invading Ukraine. We've had geopolitical issues all over the world. We've had currency crises. We've had so many things that would cause uncertainty and give everybody reason not to invest. But when we look at returns, in what people consider like a high risk space, like just a equity space, the returns are still good, really good on a 3-year basis, where 7, 8, sometimes over 10% annualized returns in these areas. So it's really important to note that there will continue to be things that are scary. There will continue to be reasons not to invest, but it's really important that you kind of look past that and invest appropriately for the time frame. And that doesn't mean that you make stupid decisions. It means that you make informed decisions appropriate to you and your life and the timeline that you're investing for. Second thing I want you to take away is that market timing isn't worth it. In times of high volatility and times of uncertainty, a lot of people's first instinct is to pull out of the markets and wait and see what's going to happen, then get back into the markets just before there's a rebound, and then get back out of the markets if bad news comes and get back into the markets. And you know what? If you could do that flawlessly, that would be the best way to invest. Unfortunately, we cannot do that. There's no computer program can do it. Nobody's been able to do it consistently. And over time, it shows that the upside is trivial compared to the downside. They say the worst thing that can happen to a market timer is to be right. And that's because you believe you have this crazy ability to do it again and again. So the best way to invest is just to stick with the fundamentals of investing. And yes, your strategy might change a little bit depending on the environment, but the principles still apply. And thirdly, diversification. Diversification is key. We've had the US do really well over the past 10 years. That does not now mean that you switch to 100% US. There's still a lot of unknowns on the horizon. A global approach is still the best and most least risky way to invest, and sticking with high quality companies has always done well. It might not do as well as high risk Indonesian companies in 1 year, or I think the last quarter Czech Republic did the best. Doesn't mean we now go invest in the Czech Republic 100%. So diversification is still really key to a successful investing experience throughout history. It's always been the same. So now let's get into what the markets have actually done. So the first quarter of 2023 was actually pretty positive in the stock space. In bonds, it's still expected that interest rates are going to come down. So we've seen a little bit of shift with bond prices. As we know, when interest rates go down, bond prices go up, and vice versa. So it's been a very long time since bonds have looked attractive, and this is definitely the one of those times when it has looked very, very attractive. Something else to note to push that point even further is look at the best quarter here under the Canadian bonds and the worst quarter here. Best quarter, I'm pretty sure we all know what happened then. That was with COVID, and we saw them drastically decrease prices, decrease interest rates. Bond prices had the best quarter they'd ever had. Same thing in 2022. We saw them drastically increase rates. Had the worst quarter that they've ever had. So yeah, bonds are gonna act how they're gonna expect, but the expectation is that interest rates will come down eventually. Some of the bad side of things is that, well, good and bad, inflation is coming down, but not as fast as we'd hoped. And there's future pressures. So whether we'll see interest rates hits this year or next year, we see drops if we still have a few more rises to go. We don't 100% know yet, but the inflation has not slowed as much as people would have hoped. Okay, then we have the Canadian market and the US market. Honestly, all the stock markets are up, largely to do with, we're expecting interest rates to drop. That does still mean, that doesn't mean that we're going to avoid a recession. We still may hit a recession, but we will see. We will see what this year holds, and this is also an important reason to stay diversified. Yeah, and now for in the markets, the part that actually matters, and that's more longer term. So, and as I mentioned earlier, it's really important to tie your investments to your appropriate time horizon. So even when we look at 5 years out, the stock market has done very well. The Canadian market, the US market, even international. This is excluding the US and Canada, which is why if you hold global, you hold a bit of everything. But everything's pretty up on a 5-year basis. Emerging markets have struggled here, and we'll see really how they come out of this inflationary environment, especially with all the talk of the US dollar not being the global reserve currency. There's a fair amount of headwind, I think, for the US in that regard. So we'll see where that shakes out. Obviously 10-year numbers are always good. When you look at charts, you always see it going up to the right. But when you're in it, it's a lot scarier than when you're just looking at a chart from even 3 years ago. When you look at COVID, during COVID and the drop, people were very scared. But now it's just a line downwards on a graph. Okay. The other thing I wanted to touch on was yield curves. And I know yield curves can kind of be a little complicated for a lot of people. So I'll just kind of explain the way that a good yield curve is, and that looks something like Japan. The further out you want to be rewarded for holding money and locking it away for longer periods of time, that is typically a healthy environment to be in, where interest rates are further out you go, the better they are. We're currently not in that type of environment. We're in an environment where interest rates are expected to drop pretty substantially to some degree. And that is creating an environment where bonds are really, really attractive. I don't really want to get into the how yield to maturity is determined, but to say that if interest rates drop and we're holding bonds, it means a large jump in what them bonds could potentially be worth. And with yield to maturities being, 4.5%, 5%, it's a really good opportunity to be buying bonds in this type of environment. As always, there's pros and cons, right? So the cons, obviously, bonds, person not paying. But one of the big things is with any interest-bearing instruments, so that'd be GICs, savings accounts, bonds included, is that if they are not tied to inflation, then depending on what inflation does, really dictates your return. Because even if with inflation, let's say inflation's at 10% and your GIC or your bond is only earning you 5%, well, then you're still 5% back. 5% worse off than if you'd had an investment that kept up with inflation. The only thing that has a very, very good track record not the only thing, but one of the biggest things that has a very, very good track record of keeping up with inflation has been property values and stocks. And stocks and property values don't do it in tandem with inflation. If inflation is up 7%, doesn't mean that your house price is now worth 7% more. But if you take a stock, this stock is suddenly worth 7% more. But if you take a decent time horizon, like a full market cycle, that's what you tend to see. You tend to see real estate and stocks keeping up with inflation, whereas interest-bearing instruments very seldom do. And even in this environment, with interest rates being so attractive, we're still not keeping up with inflation in interest-bearing instruments. So that's something else to keep in mind, that despite interest rates being higher, the position that people find themselves in hasn't changed that much when they're making a decision about GSEs versus, or GSEs or bonds versus stocks. You're still in the same position that we were, 3 years ago, where interest rates were low. GSEs were paying, 1.5%, but inflation was at 2%. That's 25% below inflation. If inflation is at 7-8% and GSEs are at 5%, guess what? They're still about 25% below what inflation is doing. So the situation hasn't changed a ton in that regard. So there's always a risk, and that's something to keep in mind, especially when choosing, what we're going to be doing over the next 5 years, and whether we're going strictly with GACs or it's being a mixed or bonds or whatever. There's always risk, and that's just an element of risk that is has been made very apparent over the last few years. But anyway, as always, kind of a brief summary. If you have any questions, if you have any concerns, please feel free to reach out to me, and I will see you in the next one. Thank you so much. Bye.